Hi, everyone. Welcome to today's discussion. We have a great lineup of topics to cover, from a recap of 2024 markets to what's ahead for the economy, policy, and portfolio positioning in 2025. As we all know, 2024 was another eventful year for investors, with significant market movements driven by economic shifts, Federal Reserve policy, and of course, the election. As we look ahead to 2025, key questions remain. Where is the economy headed? How will policy changes impact the markets? And what does all of this mean for investment strategy? We had a lot of you submit questions, and we're ready to answer. To help us break it down, we have Andy Ruzicka and Ken Stansbury, who will be sharing their insights on what's shaping the market and the economy in the coming year. To start, let's take a step back and recap some of the major themes of 2024 in both stock and bond markets. Andy, could you walk us through the key market returns and the major drivers of volatility that we saw last year?
I can do that. Thank you, Emily. Yes. So 2024, while a volatile one, certainly turned out to be a great year by almost all measures. The year was led by large cap US stock market, returning just shy of 24% for the year. Small cap US market, while followed relatively closely to that, had a rough end of the year, but still ended up about 10% for the year. International markets did not fare so well, being roughly flat for the year. And then bonds were up for a period, but ended up down a little bit for the year. And so the biggest factors that influenced these was uncertainty. And so that uncertainty really drove a significant amount of volatility last year. And the uncertainties were around two big things. One, the Fed and trying to anticipate when the Fed was actually going to cut interest rates. And then the second thing was the election and what the results of the elections would be, and therefore what types of policies could or would get put in place with a new Congress and a new president put in place. So those were the things that really drove the market last year, but ultimately we ended up in a positive space, which I think we'll all take.
There was a lot of activity at the end of the year, a lot of volatility, but we did get some answers, and one was from the Federal Reserve Open Market Committee. They cut rates starting in September. They started with 0.5%. It was expected at the time that it was going to be 0.25%. And then in November, they cut 0.25%. And then in December, they cut another 0.25%. So all of last year, from September, November, and December, a total of 1% decrease in the Fed funds rate. And so now it's at 4.25% to 4.5%. And really what's important about that is when the Federal Reserve decreases the Fed fund rate, it typically does boost the stock market in several key ways. One, lowering borrowing cost, and this is for businesses as well as consumers, makes it cheaper to borrow. Increase corporate profits. So with lower interest, businesses can refinance their debt at cheaper rates, reducing expenses and therefore boosting those profits. It's also more attractive for risk assets when interest rates start to decrease, because as interest rates decrease, the yields on the safer investments like bonds also fall, which makes stocks more of an attractive comparison. And lastly, I'll talk about the investment sentiment. Rate cuts often signal to the market that the Fed is taking action to support the economy, and this can increase investor confidence. And then in November, we also had the presidential election, which caused some volatility as well, with President Donald Trump's victory as well as what we call the red wave. It unleashed a massive rally in the dollar, and it drove stocks to record highs. And it did push bonds down a little bit because of the expectation of tax cuts and some other policies.
Well, thank you guys so much for answering that. Another question that came up a lot is, what's your opinion of the status of the current economy, and what's the direction that it's headed in 2025?
Emily, that's a great question. I mean, coming off of last year, and there's a lot of optimism, a lot of great things that we're seeing. Really, in December, we had the U.S. economy added 256,000 jobs, and that surpassed expectations. And it made it the largest increase since March of 2024. So job gains are happening. It pushed the unemployment rate down to 4.1%. And it's really just highlighting the U.S. economy's resilience. Looking at the chart on the screen, we also look at the JOLTS job openings. And if you notice there, going back from the recession, you see it trickling up here, kind of, up and down, up and down. And then during COVID, it really spiked up. What we're seeing now, it's come down to close to pre-pandemic levels. And we view that as healthy. We think that if someone wants a job right now, then it's available.
As long as people aren't worried about where their next dollar is coming from, then generally they're going to go out and spend their money. And with consumption being almost 70% of GDP, that lends itself to the likelihood for a good 2025 from that perspective. One of the additional sections that we think is going to be a significant positive impact on GDP in 2025 is business spending or capital spending. A lot of what we heard in meetings last year, especially with executives or business owners, was this wait and see mentality. Let's wait and see what happens with interest rates. Let's wait and see what happens with the election. And so all that wait and see meant they weren't making decisions about making large expenditures. Well, with both of those questions answered at the end of last year, we're seeing a lot of that pent-up demand start to make its way out. And so we're anticipating that business fixed investment to be a nice contributor to GDP this year. And when you combine strong consumption and strong corporate spending, that's north of 80% of economic growth. Those two things should certainly help influence that. Now, not everything's going to be, sunshine and lollipops. We do think that given some of the potential trade deals that are going through, we think that trade and net exports will actually be a negative on our economy in this year. And then residential will be more of a drag than what it has been in past years. Not by much, but you net those things out, a strong consumer, strong corporate spending should lead us to a really nice, solid growth rate for 2025. We've seen everything predicted from, 2% to 3%. So the idea that we could end up in that 2.5%, give or take a little bit, a pretty safe bet, we would say at this point.
So what impact do you guys think that the new administration is going to have on the markets and the economy in 2025? I think a lot of people are wondering.
We've gotten this question a lot. I'm gonna focus on some of the positive things and really going back to Trump's first term and seeing what his focus was in his economic platform. Back then, it was the 2017 tax cuts. Well, what does he want to do now? Looking to renew those, to extend those. Also looking at deregulation. That's the cost of doing business, so that can help save money for corporations. And then you also have possibility for additional corporate tax cuts in there as well. So I think when you roll all those together and what happened in the first term, it did lead to an economic boom. And we did see GDP grow at 2.5% up until COVID. And we also saw unemployment at 50-year lows. So I think there's definitely some positives behind this administration's agenda.
And there could be some offsetting potentially with some of the other policies that have been heavily talked about out there. I think probably the biggest one's tariffs. What we have to take into account is that the likelihood of implementing tariffs in the manner to the degree that was talked about on the campaign trail is not very high. The early signs are that the Trump administration is likely to use tariffs more as a negotiating tool or a threat to get better trade deals or get other things that they may want. And so our belief is that while if implemented to the full extent as talked about on the campaign trail, that could be a significant negative impact due to a significant increase in inflation from those higher costs being passed on to the consumers. We don't think the likelihood of that is very high. And so far, the early signs are heading that direction, which is good. The other possible negative impact economically would be immigration policy. And similar to tariffs, what was talked about on the campaign trail was pretty significant compared to what we think will actually get put in place. The reason for that is the cost. So to put an immigration program in place of the degree that was talked about, you're talking about hiring a significant number of judges. You're talking about hiring significantly more border patrol, talking about building and acquiring detention centers. All of those come with a very significant cost. something that ultimately Congress would have to get involved with to create the funding. The immigration policy is one that doesn't necessarily have, while Republicans do have control of all three houses, we don't think that necessarily everybody's on board with that degree of an immigration policy. And so it's likely there again we get some watered down version of it. Like we kind of started off with the fact that we do think we're going to see positive economic growth this year. When you take kind of the positive impacts of the policies and you net out the potential negatives, we think it'll end up being a good good for the economy. And as long as things aren't too extreme as far as their implementation, we should be able to keep inflation in check as well.
Thank you guys so much for addressing those. So another question that we got is in 2024, we had a lot of focus on the Federal Reserve. So how do you think they will impact the markets and the economy for 2025?
That's a great question because a lot of the volatility, the market returns and the market reaction to the Fed was based on that. And what we're seeing is that back in 2024, so the last rate hike was in July 23, and it took a while before that first rate cut. And the Fed consistently at press conferences talked about being data dependent. So when you're data dependent, you don't have a fixed schedule or a predetermined path on how these rate cuts are going to happen or when. So what they've been looking at for every Fed meeting is inflation, core inflation, everything, PCE, all of that information, employment data, as well as GDP growth. And they're using all of that to formulate whether or not to stay or to decrease. And it's really worked out very well. We believe, in the beginning of 24, there was a lot of talk about a hard landing for the economy. Then they started talking about a soft landing for the economy, talking about other economists and analysts. And there ended up not being a landing. It ended up being a good economic year for the U.S. economy. So we think what he's been doing has worked very well. We're hoping to see that in 25 as well.
Great point. And for the first time, as you can see on the chart, for the first time in the last 3 or 4 years, you've actually got a market that is expecting interest rates in the future to be higher than what the Fed is projecting them to be. And that could possibly be just because the data hasn't caught up yet. But what we've witnessed in the past, and kind of a phrase that got popularized after the Great Recession in 08, 09, was don't fight the Fed. In the past, it hasn't made sense to fight the Fed. But they're going to continue to watch the data, as Ken said, and it's likely they could pivot from their existing projections, therefore leaving the rate flat where it's at, so higher for longer. Or if more extreme type policies are put into place and we start to see inflation tick up, you could see the Fed raise rates. But one of the beautiful things is that right now, with rates where they're at, the Fed has the ability to cut and continue to support the economy. So if we do see softening, they do have that tool in their tool belt to be able to pull and keep us from going into a deep recession.
So with the S&P 500 returns of more than 20% for the last calendar years, what are your expectations for the S&P 500 in 2025?
Another one we're getting a lot of. And so I would say first and foremost, continue to expect volatility. We talked about how last year was volatile. The biggest drivers were uncertainty. While a couple of those uncertainty questions were answered, there's different uncertainties now regarding what types of policies will get put in place, what the Fed's going to do with interest rates, if they're going to leave them flat or they'll actually continue cutting, those types of things. But ultimately, what this chart that's up now shows is that even during positive years, within those years, the market has pullbacks. It's very healthy. And on average, those pullbacks have been over 14%. Our expectation is that volatility is going to continue. But all in all, we do think that there's a really good shot that we end up with a positive return this year based on economic growth continuing to happen and earnings being delivered. When you go back and again, kind of looking at history, which isn't predictive of the future, but sometimes you see a pattern here. This chart shows how the S&P has done after you have had 2 years of 20+% returns in a row. And so while it's unique, it's not the first time this has happened. But you look at the average, north of 12% has been the average return, and 75% of the time it's been a positive return after 2 years in a row of 20% returns. So that bodes well for us. The next slide shows how the S&P has done after the Fed's first rate cut. And so, as Ken mentioned, they had their first rate cut in September of last year. And so you look 3, 6, and 12 months later, returns have generally been positive. But then you go 3 years out, 5 years out, and the returns are significantly positive. And so looking a year out, on average, the return has been positive to the tune of 7.2%. But then you go 3 years out, the cumulative return over 40%. In 5 years, almost 80%. And so a big factor to whether those future returns end up positive or negative is whether we go into a recession or not. Well, I feel like we made a pretty darn good case that the likelihood of us going into recession is very low. And so when we look at what the returns have done after the Fed's first rate cut and no recession, they're even better, almost 20%, 12 months later, over 70% 3 years later, over 100% 5 years later. So not to say that we're predicting those things to happen, but in this particular scenario, in the environment that we're in currently, there have, historically been times where the markets have continued to deliver strong positive returns.
Yeah, Andy, and what we've been getting a lot of is the market overvalued? Where do we go? And I definitely want to address that because you do see that in the media often that it's overvalued, valuations are high. Looking at the chart, you can see they are about one standard deviation above the 30-year average. However, that's not the full picture. And we also know that valuations can stay extended for extended periods of time. So when we dive in, we're looking at 2024, stocks just delivered exceptional strong returns. And really that was due to a Goldilocks combination of strong earnings growth plus rising price to earnings ratios. However, the earnings picture looks very robust going into 2025. And this is based on S&P 500 consensus expected earnings. And the earnings expectations for the mega cap growers, such as the Magnificent Seven group of stocks, look even better and have really continued to show impressive acceleration. So after 2 years of a rise in P/E ratios, valuations appear to be stretched a little bit recently in their 90th percentile. However, we believe that it's going to be the earnings are starting. They're looking okay. They're looking good. So I think right now, earnings will truly have to carry the day. Amongst the other things that we have talked about, corporate earnings will definitely have to be there, and that we think they will.
How does all of this that we've talked about today impact portfolio allocations?
And I would argue that's probably the most important question of the day is we've got all this data, we've got all this information, but what do we do with it, and how are we utilizing it to implement with the portfolios? And so ultimately, with where we believe things are at right now, we don't see a lot of changes happening on the equity side of the portfolio. We've been overweight to growth stocks versus value and large caps versus small and international, and we're going to continue to maintain that overweight. And one of the big reasons for that is we've got a slide that shows the amount of the growth type industries, the amount of cash that they have as a percent of their current assets, significantly higher than the typical value industries, which is a sign of financial strength. We also show, there's also a chart that shows how much they're investing in CapEx and the amount in R&D, and those are all higher than the value sectors. And so while historically investors may think of value companies being more having higher quality, what we're seeing is a potential shift in that trend, primarily due to the mega cap tech companies because of their incredible financial strength and their continuation to be able to deliver earnings and continue to grow that financial strength.
Yeah, Andy, and then when we're talking about non-stocks, specifically bonds, their purpose in our portfolios is to be a ballast, a stabilizer for the investment portfolio. So with I'm not going to say uncertainty, just with some of the fluctuation in the interest rates with the Fed, think it has it down, expectations are lower than where the market sees them. We could see some more fluctuations in that interest rate. And we think right now it's a good time to just dial back a little bit. Minor change in the portfolio for bonds is to dial that interest rate sensitivity back a little bit. Because what happens when interest rates do decrease, bond prices change. So interest rates decrease, bond prices go up, and then vice versa. And then also the other part of the equation is duration. The longer the duration, more volatile it will be to those interest rate moves. So we think it's very prudent to just dial that back a little bit and then, see what happens with the Fed in the future, and we can make adjustments in the future.
Sense. So more of a neutral position.
Yes.
We get asked a lot of, hey, well, how are you guys managing the risk? And with portfolio management, generally the biggest risk is not an economic factor, is not necessarily a political move or anything like that. It's emotion. And so we continue to manage the risk by kind of filtering out all the noise that's associated with the news channels and watching TV and clicking, and just focusing on the fundamentals of the economy and the fundamentals of the holdings within the portfolio. And as long as they continue to be strong, then we're going to continue to maintain those holdings. And so keeping that long-term view and not making emotional decisions have in the past allowed us to outperform indexes. And so that's our whole role, is to continue to do that, to continue to take the emotion out of our portfolio decision making. And that should allow us to continue to outperform. And so at this time, we don't really see the factors there necessary to move the actual risk dial. If we get to that point, we would certainly do it. But we don't think now is the time for that. But we're going to continue to keep a close eye on it. And there's going to be market changes, there's going to be economic changes. Obviously, fiscal policy changes are coming. And so we'll continue to keep a close eye on that. And if we need to move the dial back, we will. But we just don't see right now as being the time to do it.
All right, that wraps up our discussion today. We've covered some key takeaways from 2024 and what to watch out for in 2025, from the economy and markets to policy and portfolio strategy. A big thank you to Andy and Ken for sharing their insights, and thank you everyone for tuning in. If you have any questions or want to dive deeper, don't hesitate to reach out to us. Also, be sure to give us a follow on LinkedIn, YouTube, Facebook for more market updates, insights, and event announcements. We really appreciate your time and look forward to staying in touch. Have a great day.